The Australian Financial Review.
Hello, I'm James Thomson, Senior Chanticleer columnist at the AFR. Welcome to our weekly news breakdown of all things business, finance and markets. With me today, it's not Anthony McDonald, who's taking a well-earned break, but we've upgraded to the big cheese, the AFR's Editor-in-Chief, James Chessell.
Big cheese, big week, and big shoes to fill, JT.
Fantastic. Well, this week we ask what Deloitte's AI disaster says about the share market bubble everyone's watching. We try and explain what the surging gold price says about global politics. And we look ahead to ANZ Bank's big date with Destiny. But first, James, our industrial relations guru David Marin-Guzman broke a cracking story this week about some more shenanigans down in my hometown of Melbourne, where the CFMEU walked off several big infrastructure projects this week, including the Westgate Tunnel and the Metro Tunnel, as part of a strange turf war with a rival union. James, what on earth has happened here? And is this another black eye for Jacinta Allen's Labor government?
JT, I'll tread carefully here because I know you are a proud Victorian, but it is hard to find a silver lining in this particular cloud. I think even you would agree.
Yeah.
As David reported, the CFMEU, along with a couple of other building unions, the ETU and the Plumbers Union, we called David, by the way, DMG, because you have to have acronyms in this game.
Yes.
So they pulled hundreds of workers off their sites, ostensibly because of safety concerns about an alleged lack of evacuation exits. I say ostensibly because union sources told David the stoppages were expected to continue until a big construction firm, John Holland, withdrew its deal with arch CFMEU rival, the AWU, for another mega project, this time in South Australia, the Torrens to Darlington Tunnel project.
Okay.
On all of that, James, is another way of saying the stoppages in Melbourne were a way for the CFMEU's Victorian branch to heap pressure on John Holland in South Australia, where the union has far less industrial muscle, which is another way of saying, as you said at the start, it's a turf war. And this would be kind of funny if it weren't so serious. And I'll make 2 points before getting your perspective as our resident Victorian bull.
Yeah.
But first, the Westgate Tunnel action or stoppage is the latest drag on the state government's mega infrastructure agenda, which was branded as the big build. And budgets on this collection of projects have blown out by $65 billion, which is an extraordinary amount of money for a state. And part of the reason Victoria's debt is forecast to reach $194 billion in 2029. And the second point I would make is this is the CFMEU. That's the same union state and federal governments have promised to clean up since David and Nick McKenzie exposed rampant corruption and illegality within its ranks. So it's not great, James. I think even you would agree.
You're absolutely right. Everyone was quick to point their fingers at everyone else here. You know, the contractor, John Holland, said, this is a matter for the government. Transurban, who's, been developing the Westgate Tunnel, it's a matter for John Holland. And straight away the government said, no, it's definitely a matter for John Holland. But I think, yes, Victoria's been caught in the crossfire of both the turf war between unions and one that involves an entirely different city. So a bit of sympathy there. But the Allen government's been warned, as our reporting has shown, about the CMFEU's issues with these big build projects in the CMFEU for years.
Correct.
2023, the first warnings have come in, and nothing has changed particularly. The focus is on just getting these projects done and sort of hoping, to move on with it all. So this is a bit of karma, might not be the right word, but it's reaping what you sow. If you don't clean this stuff up, nip it in the bud, you're going to have these problems that keep coming back time and time again.
I agree. I'm glad you brought up those warnings that did reach the Allen government and the Labor government previously. They seem to have been ignored. And if we want a serious conversation about productivity in this country, this is an area that needs to be looked at with a lot of intensity, I think.
Yeah, absolutely.
Now, James, as you know from my regular text messages when I'm at Woolies on Saturday listening to you and Ant, I'm a regular listener to the podcast, and I've noticed you and Anthony seem to have an unhealthy fascination with Guzman and Gomez, the burrito chain that took the market by storm when it listed on the ASX way back in June last year. Now, more recently, the company's shares have been under huge pressure, and there was a bit more spice in the chili on Thursday. Talk us through that.
Yeah, so poor old Guzman Gomez, that they've had a rough run in the last few months. The shares were at a record high in February. They've come back about 47% since then. And it's just a story about the growth slowing. So in the 2025 financial year, same-store growth was running about 9.6%. In August, the company said, well, the first 7 weeks of the new financial year, sorry, but sales are only running at 3.7% growth. That's improved a little bit, we learnt this week, to 4%. But it's still not where the market expected. The market had hoped that this thing would keep growing at 8%. It's since had to revise those views. But Guzman Gomez did an interesting thing, and they launched a share buyback, which is when a company buys back its shares, and that helps push up the share price.
Yep.
$100 million share buyback. Usually these things are sort of well received. And that's what happened on Thursday morning. The stock jumped. It was up 6%. But by the end of the day, the stock was down 2.5%, and on Friday morning, it's fallen another 2%.
Yeah.
And I think this is just investors saying, yeah, the share buyback's good, but we've bought into this thing as a growth stock. We want growth, and all of a sudden, the growth isn't there. So I can't believe the amount of research that you've done ahead of the podcast, but you've chatted with a GYG shareholder this morning.
I wanted to be up on my GYG chat,
Yes.
James.
What are they telling you?
Well, start with the good. They're happy with the share buyback, although they did make the point that it's a bit unusual for a company that's only been listed for whatever it is, 15 months or so now to be, and obviously part of the reason you float is to raise capital, effectively giving it back to shareholders. So on the capital management front, there was a tick.
Yes.
Where there was concern, it goes back to your point about growth, is the US experiment hasn't worked. There were high hopes that they could do what they're doing here in the United States, but some of those fast food giants over there like Chipotle are eating their breakfast and eating their lunch, so to speak.
Yeah, it's a tough market to break into. I mean, I think this is still it's a fine business. It's growing reasonably strongly in Australia. They really have hit a chord with consumers, but I just think people got very excited about this after the float, bid it up to an unreasonable price, and we're just seeing some of the air come out of the tyres. Maybe in the long term this might be a bit healthy, but for now it doesn't feel very pleasant for GYG investors who've nursing some pretty big share price losses if they bought in towards the start of the year. So we'll see where this one goes. All right, James, let's move to our first topic. And it's fair to say we're in the grip of two great bubbles in the financial world right now. The actual artificial intelligence bubble and the bubbling people calling out the AI bubble.
Absolutely.
But the question of whether the trillions of dollars that are being invested in AI infrastructure and chips and technology actually generate a return is pretty serious for our retirement savings and probably our society, given the potential impact on jobs. While the big US tech giants are still talking things up, closer to home, we got a fascinating insight into the big question of will this technology actually work? Consulting firm Deloitte was forced to refund the federal government after a $440,000 report it was commissioned to produce was found to be riddled with errors produced by AI. James, this has been the biggest story in the fin this week by some margin. Do we have a really good understanding of what went wrong for Deloitte?
We're starting to, JT, and you're right. It is the story that, notwithstanding a peace deal in the Middle East, record share markets, record gold price, an AI bubble, this has captivated AFR readers like nothing else.
Yeah.
We broke the story back in August, and in the unlikely form of our New South Wales political correspondent, Paul Karp, because he'd been chatting with an academic who at Sydney Uni who'd gone through the report and found that some of the citations didn't make any sense. They were either completely wrong or made up. And the obvious explanation for this was AI hallucination. However, Deloitte didn't want to say anything about it. So Paul wrote up a couple of yarns and then a few more errors were found, and that might have been the end of it. But late Sunday, our professional services editor, Edmund Tadros, broke the news that a revised version of the report had quietly been uploaded on the department's website with deletions of certain footnotes, a rewritten reference list, and corrections to multiple errors. It sounds a little bit like my university career. And then on top of all that, JT, Deloitte also agreed to a partial refund. So still at that point, no real explanation about the role of AI in that. But we also happen to run into Senate estimates this week, and the department's up, the departments of finance is up. And by the end of that, we find out that the Department of Finance is changing its rules about whether these consultancy firms or how these consultancy firms should use AI. We find out that AI was definitely part of it. We find out it's such a small world that the Department of Employment Workplace Relations Secretary Natalie James is a former partner at Deloitte. She apparently had nothing to do with the report itself or the commissioning of it, but it just reminds you what a small little environment is. These professional services firms rely on government work for a big chunk of their Australian revenue. And then on top of that, and embarrassingly for Deloitte, they're relying on AI advice and training for a bigger chunk of their global revenues. So for Deloitte to stuff up so publicly and so badly is a really bad look for them when they're spending a lot of their time telling their clients, their big corporate clients, that this is how you should do AI. And on top of that, JT, Deloitte also agreed to a partial refund of the $490,000 taxpayers stumped up to pay for the report in the first place. It's an amazing story, and I think what drew the really big audiences is not just the global implications, but also stories that are well-read are always relatable. And I think we all play around with ChatGPT, we all play around with Gemini, we all see the outputs that are spat out by these things, and it's a salient reminder to all of us to check your homework.
Yeah, it's fascinating though. I mean, my stream on Twitter or X or whatever it's called these days, it was full of like all the big macro strategists I follow from around the world. They were all tweeting this story, telling me we're going to invest how much in this AI sector. Does it shake your confidence in AI a bit, James?
Not really. I think this is a case of someone using a tool and not using it particularly well. I don't think you can blame AI, but I think you can use this as a reminder that you can't be over-reliant on it, and that it's pretty well established and pretty well known by everyone, even with a rudimentary knowledge of AI, that some of the stuff it pushes out is not reliable and needs to be checked. And that's where Deloitte fell over. I don't think any firm in that sphere wouldn't be using AI. You know, I'm constantly reading stories about how CEOs are under pressure from their boards to come up with more ways to use AI in their businesses. And I think that's pretty sensible. You've just got to use it properly. And then you've got to be transparent, I think, James, about the way you use it. Maybe if we take a step back, the investment in deals in AI shows no signs of stopping, does it? And this week, Jensen Huang, the CEO of the chip giant NVIDIA, did a big interview, and you wrote about it, where he sort of laid out his vision for where AI goes next. He's a high conviction guy, but he's not losing any confidence, is he, JT?
Oh, no. He's a bit of a salesman too. Like he rocks the black leather jacket and the black T-shirt. And he certainly isn't losing any confidence, and he's not saying we're sort of slowing down on this train. It's a really good interview. I'd encourage people to go have a look at it or listen to it. He sort of lays out the 5 layers of AI. You know, there's energy at the bottom, and then there's chips, then there's infrastructure, and then there's these large language models that things like ChatGPT and Gemini are built on. And then there's these applications that people will start using in their business. And he makes the point that the tools business, like the internet's a tool and Microsoft Excel is a tool, that's worth trillions of dollars. But now we are able to get these AI agents to use these tools themselves autonomously. His point is if we can pull that off, then that can create a business or an industry worth hundreds of trillions of dollars. And then, yes, you would file that under H for he would say that, but you sort of get where he's coming from. The key to it, though, is computing power. And his point is we need to, A, develop as much computing power as we can and bring the cost of that computing power down, and it'll all work. But this is the question. How much money is required to build that computing power? Well, the answer is trillions and trillions of dollars. And will people get a return out of it? I think this Deloitte story is timely because you look at it and you say, okay, you know, I get the idea of AI, but if it's not able to do what it says on the tin, if we're going to get, mistakes and problems like have been exposed by this Deloitte episode, do people suddenly say, I don't really want to invest that next $3 trillion in AI. I think we've done enough. It's just not working. That's how this whole steam train can go off the tracks a bit.
I'll answer that question for you, JT. Yes, they're still going to invest.
Yeah.
Like we were looking at a Goldman Sachs estimate of AI debt issuances this year, and it's up to $141 billion US, which I think is sort of more than all of technology last year. A lot of that's being done by tech companies, but the numbers are huge, and I don't see any slowing in momentum at the moment, which brings me to my question to you. We're old enough to remember the .com bubble.
Yeah.
We're not old enough to remember the tulip bubble in the 1600s, but bubbles don't mean that the technology is bogus. It means that the technology is overvalued, right?
Yep.
The internet really kept going after .com. It's just everyone got a bit ahead of themselves. But where do you think we are? Like, are we in bubble territory, JT?
Yeah, I think we're in bubble territory. Back in the .com boom, everybody used to hang it on this company, Pets.com.
That's right.
Because they had a valuation of, $1.8 billion and sales of $5 million.
Yep.
Well, there's an AI startup called Thinking Machines. They raised $2 billion at a $12 billion valuation. They don't even have a product. Literally nothing. And so I sort of see that, and I think Jeff Bezos said it last weekend. There's billions of dollars being given to 6 people in a room who just say they can do something in AI. So that's bubbly for me. The problem for investors is bubbles are great periods to make lots of money.
Correct.
The key is trying to know when the bubble's going to deflate, and that's the hard bit that I think will trip everyone up. So let's see. But James, you're the big boss here at the Fin. How do you envisage us using AI in the future? I don't know if you've seen, but you can actually, using Gemini, generate an entire podcast just from a report. And it is pretty amazing technology, but I don't think you can put a price on the dad jokes that we serve up on this podcast each week, can you?
Well, I actually asked ChatGPT if you could put a price on dad jokes, and it said no because they have no value. So, which is actually better than anything I could come up with. So I don't know. That's a bit worrying, JT, to be honest. I think media will, like every other industry, embrace AI over time. I think we operate in an industry where trust is absolutely critical, although I would have said the same thing about professional services.
Yeah, indeed.
And I'm very happy to say that in our masthead, we're being super careful about it, and we don't want to be at the bleeding edge. We don't see much value in that. But you can obviously see things in the future, semi-automated tasks that might lend itself to some form of AI assistance.
Yep.
To give you a small example of a very controlled experiment we have conducted, we've looked at SEO headlines, which traditionally journos, they get to it at the end of the story.
These are search engine optimized headlines that help Google find us.
Yes, exactly. Thank you for sorting out the jargon. It's not anyone's idea of a good time putting an SEO headline at the end of it once you've slaved away over the yarn. But what if AI, for example, came up with a bunch of options that a human would then look at and check that are probably going to perform well than anything the journalist came up with. It's a really small example, but I think the job for us is to tinker around the edges. And then the other thing, and this is super important, JT, is that we've got to be really, really clear. Our readers and our subscribers expect everything that we publish to have been done and checked by human beings. So if AI were to be involved in anything, we would need to be very transparent about where it was used.
Yeah, good call. Good call.
Okay, JT, let's move on to our second topic. AI is still the most talked about trade around the world, but this week there's been a second big theme in markets, the rise and rise and rise of gold. The price burst through $4,000 US an ounce this week. It's up about 20% in the past 6 weeks and above 50% this year, which is much better than the 14% return for the poor old ASX 200 and 15% return for the S&P 500. Now, James, Speaking of bubbles, everyone seems to be talking about gold suddenly. School holidays here, probably school holidays where you are. I was at my son's basketball game yesterday morning, and two of the dads there were chatting about the gold price and where it was going to go. What's brought on this gold fever?
Well, partly it's just the momentum of those big price moves. We love a round number in markets, and once you see a nice round number like 4,000, first time ever through that mark.
Psychologically important, JT.
Psychologically important, that's right. What's happening is gold loves drama, and we've seen heaps of drama this week. We've got the US government is shut down. Doesn't seem to be affecting too much, but it is shut down, and you've still got the Trump administration sort of calling for rates to be lower and doing all sorts of fun things. We had more drama in Japan, where they've just elected a new leader, and she'll soon be the prime minister. Her apparent response to rising inflation is going to be more fiscal stimulus, which is worrying for investors, and the yen's fallen, equities have gone up. But that too has helped the price of gold. And then in France, we've had this absolute political mess. I think it's the fifth prime minister has resigned in 2 years or something. This one had only been in 23 days. And so again, people see that and they think political mess, government's no good, don't want to own the currency or the bonds. Please give me gold. And that's helped to sort of push the price along. And we've hit these record levels constantly through the year, and now we end up above 4,000 US. It's quite remarkable.
Let's just dig into it for a second, JT. I keep hearing about this thing called the debasement trade. Can you explain what it has to do with gold?
Absolutely. Well, I'm glad you asked, because it's not often I get to mention King Henry VIII on this podcast.
I was really hoping you'd go there.
So back in the day, he was a bit of a big spender. He was fighting some wars against France, including other places. And he got the gold and silver coins, and he reduced the amount of gold and silver that were in them and added base metals, particularly copper. And so he debased the value of those coins. Now, fast forward to today, there's not much gold and silver in any of our coins, but the way you debase a currency is by running the economy hot. Basically, these countries, so the US, France, Japan, Britain's another one, they've got too much debt. And they've sort of got to the point where they've got so much debt that the normal things you do to reduce debt, cutting spending, raising taxes, are completely unpalatable to the voters. So what do? You try and inflate your way out of it. You let inflation rise, which reduces the real value, the inflation-adjusted value of your debt over time. And so you try and inflate away the debt. But the problem with that is that you wreck the value of your currency in the process. So what do people do? They go to assets that are outside the financial system. Gold's one, silver, platinum, palladium, and of course, cryptocurrencies, Bitcoin.
These are assets that you can't just magic up more of this stuff. And if, you've got to go to a mine, it's not something a government can play with so easily, right?
That's right. Gold is eternally loved because it's got its value, it holds its value, and it doesn't matter what a government does or a company does or some other investor down the street does, you're sort of protected from all that. That's the debasement trade, and it's gaining more popularity as these countries deal with rising inflation, huge amounts of debt, increasing polarization, and these bad political decisions that seem to be continuing to be made. But James, we like to look at the US and the UK and France and Japan and think, well, that's not us, We do a much better job of running the finances of the country. And I guess that's true to some extent. But we did see a pretty good example this week at home of government largesse, that the federal and Queensland governments, they agreed to spend $600 million to rescue a pretty run-down old copper smelter in Mount Isa, which happens to be owned by a $63 billion miner called Glencore. I mean, are we sitting in the glass house chucking stones?
Yes, we are. The constructive way to look at it is a combination of factors, the pandemic and the pressure that put on logistics chains around the world, and the political winds, which have veered more in the populist direction, means that governments of all persuasions are trying to beef up their domestic manufacturing capabilities. And this takes different forms. You've seen it in America with the Make America Great Again agenda, and Trump spending a lot of time trying to encourage people to make things in the US. And you see it in Australia with the Labor Party with, a more moderate version, but Anthony Albanese talking about progressive sovereignty. On the other side of the aisle, we saw Andrew Hastie stand in front of an old Ford Falcon, I think it was, and complain about the fact we don't spend lots of taxpayer money building cars in Australia anymore. I'm verbally him a little bit, but that was essentially his message. So there's this broad overarching theme, which is in this very uncertain world, all that stuff you mentioned in relation to gold and add the geopolitics over the top, we should be making sure that strategically important manufacturing outputs, we can get our hands on them. I guess the question is, though, JT, is copper strategically important? There are arguments for and against. And then secondly, you alluded to this, does a really profitable Anglo-Swiss miner such as Glencore need government support? And I think we've got to be really careful in this country that we don't get in the business of making political decisions. Nobody wants to see people lose their jobs, but we do know what happens in these situations when politicians don't want bad news, even if, unfortunately, it is a sign of the economic times. The other worrying thing for the Australian taxpayer is literally as soon as this announcement was made, our reporters in Canberra were getting press releases from the Tasmanian government saying, well, we have the Bell Bay smelter. That needs some money. There's the Tomago aluminium smelter, which is controlled by Rio Tinto, another hugely profitable international company that's got its hand out for funding from the New South Wales and federal governments. To be fair, power prices are up. There's a bit of competition from other parts of the world. It's not an easy business to make money, but industrial policy is often referred to as picking winners. And, is there an argument if you were going to pick a winner, maybe helping out people who want to build data centers in this country might be a better bet? We've spent a lot of time writing about this. It's not just the Mount Isa story itself, JT. I think it's really interesting because it says a lot about the direction this government wants to go in and the kind of future it sees for Australian manufacturing.
Yeah. I'm starting to wonder whether the Financial Review should be building a smelter in its offices at some stage. But there is a bit of if you can't beat them, join them here, isn't it? Like, this is a global story.
Yep.
Governments all around the world are intervening in all sorts of ways in weird sectors. We saw this week the Trump administration bought a 10% share of a critical minerals miner in Canada. I thought they hated Canada, but there you go. As investors, do you just sort of have to accept that this is the way of the world now? The light hand of government is now a pretty big clenched fist ready to wade into most sectors?
You could make the same point about Australia, JT. We've all got kind of recency bias with this stuff, but I would remind us that the government is standing by to bail out an airline if needs be, which maybe not the best idea. It's put a lot of money into quantum computing business. It's put money into Arafura Rare Earths, which is as it says on the tin, a rare earths company backed by Gina Reinhardt. It is investing taxpayer money in all sorts of different places. So I think that just proves the point you just made.
Yeah. James, we love questions here, and we had a question this week from Jenny, a great one about gold. She says, when I read billionaires recommending to increase their gold allocation in portfolios because of the imminent crash of the stock market or something like that, are they talking physical gold or gold ETFs or gold miners? Jenny's got shares in a gold mine at the moment, but would shares in a gold mine or a gold ETF really be a hedge if things turn sour? Or should I be buying the physical stuff down at my local Costco? Now, Jenny's not joking here. In America, they do sell bars of gold at Costco, and they've been a very popular product. I was down at our local Costco, and I didn't see any gold bars, unfortunately, but what a product lineup. Jenny, we can't give you personal advice, of course, but it's a great question because you have named the different ways you can do this. Gold miners tend to lag the gold price a bit because while the gold price is important for a gold miner, extracting the stuff comes with all sorts of complexities and challenges. So they tend to lag a little bit. Gold ETFs have been very strong, and of course they have to buy the physical gold to support them. That's an easier way for people to play this gold theme. Physical gold is harder, like where do you store the stuff? What do you do with it? How do you carry it around? But it's an interesting question. James, the other sort of related question here is we own a lot of gold as taxpayers. The RBA's got $15.7 billion worth of gold in its reserves. They're not actually in Canberra or Sydney. They're held in London in the Bank of England's vaults, you'll be pleased to know.
Yep.
And gold mining, because of the surge in the price of gold, is going to become our second biggest export, I believe, behind iron ore, according to the Minerals Council. So this gold story actually is going to intersect with the economy in different ways over the next little while, just because of that surge in the price. So we're all exposed to this in a way.
One of the reasons we don't give out personal advice is, well, in my case anyway, JT, is I'd be terrible at it. Because if you were asking me at the start of the year, what should I invest in? I'd be like, oh, God, everything is way too expensive. Property is too expensive. Shares are too expensive. Gold is too expensive. And here we are in October and, everything's gone up. It is a really unusual time to have all of those different asset classes go up. As you said, I think the general point you can make is there's different reasons for buying into gold. Like a gold company, you've got to have faith in management, for example. A mining company, there's different aspects to that, and they can add value or subtract value depending on their competence. But in any bubble situation, and we're seeing this not so much in the gold sector, but perhaps in private credit, for example, when there's frothiness in the market, that's when people tend to come in and try and take advantage of investors. So I think that's a really important thing to keep in mind for people out there who are looking at all these surging asset values and saying to themselves, I want to get a piece of this. Be careful, go with reliable names, go with transparent investment opportunities, and think about it deeply before you dive in.
Peter Lynch is a famous investor on Wall Street. He was on a podcast this week. Great bit of advice. Know what you own. Understand what you're getting yourself into, and don't get struck down by FOMO, because it doesn't always end well.
Warren Buffett was a great one for that. If you can't explain the businesses you're investing in, you probably shouldn't be in them.
Yeah, well said. All right, James, we'll come back after the break and look at one of the biggest days in banking this year. Back in a sec. Well, welcome back. If you want to know more about what we're talking about today and a whole lot more, AFR subscribers can sign up to the Chanticleer newsletter at join.afr.com/Chanticleer. Every Saturday morning, the newsletter pulls together the best Chanticleer columns from the week and delivers them straight to your inbox. All right, James, I am excited. Monday, Melbourne, ANZ is going to host its long-awaited strategy day. The new chief executive, Nuno Matos, he doesn't mind making a few waves. He's cut 3,500 staff. He's redone his executive team. He's sealed a big deal to get ASIC off his back. What are we going to learn about the bank on Monday?
It's been extraordinary, hasn't it, ANZ? It was the sleepy member of the Big Four, I think it's safe to say, and Nuno's put it at the top of the pile, certainly in terms of audience engagement for the AFR. I read your column about his latest appointment to run the retail bank, which traditionally in the Big Four is the main job outside arguably the CFO and definitely the CEO. In normal situations, you'd go with an experienced banker, someone who's worked on the tools for a long period of time. Just talk us through what Nuno's done, and then we'll go back to your original question. Nuno's
gone with someone from McKinsey, a consultant from McKinsey. He's worked at McKinsey for 29 years. This guy, his name's Pedro Riera. His only experience at working in an actual bank was a 5-month summer internship at Goldman Sachs back in the 90s. So look, I mean, it's a big challenge. Lots of people make the jump from consulting to executive life. It can be done, no problems, but it's a big challenge to step right in from 29 years at McKinsey into ANZ, where all the eyes of the world are on you. So it's a big, somewhat risky call, I think.
It sure is. And it tells you that Nuno feels, and, we've both caught up with him, that he has to move fast and he has to move decisively. The question is, and this is what we're looking for on Monday, is execution. How are you going to do it, and what are the risks? And the 800-pound gorilla in any conversation about Australian banking is Commonwealth Bank of Australia. Recently, a few days ago, we reported that they have moved their IT system, and I'm simplifying it here, onto the cloud in a deal with Amazon. Yeah. They've been doing it quietly. And CBA's market dominance can be pinned to a lot of the investment that was done on the IT side, stretching back to CEOs like Ralph Norris. The others, I think it's fair to say, JT, are a long way behind. And Nuno can say all sorts of things about the culture and costs and being smarter. But how do they catch up on that technology side? That's the thing I struggle with. He may turn out to be a really good CEO for ANZ, but he is starting a long way back.
We've seen that Nuno can cut costs. He's going to be good at that. He's a no-nonsense character.
Exactly.
But getting the tech right and growing revenue against the likes of Commonwealth Bank and Macquarie, that's the bit I think we'll be really watching on Monday to get some clues about.
It's going to be super interesting, as you say.
Yeah, a couple of other things to watch. Tuesday, we get the RBA minutes, so we'll learn a little bit more about where they're thinking rates go next. And on Tuesday and Wednesday, Citi, one of the big investment banks, has got a big conference up in Sydney. Some great macro visitors, so we'll get a little bit more of that. Why is gold doing what it's doing? What's the AI bubble? What's going to happen next there? So it should be fun to watch too. This week, our question was from Jenny in Western Australia. If you've got a question you want to send in, you can email us at chanticleer@afr.com. You can also send us a question in audio form. Just record a voice memo on your phone, include your name and where you're from, and email it through to us. And of course, there's the widget on the Chanticleer articles at afr.com where you can send your questions in too. Well, James, it's been a big week, and I think next week's going to be a lot of fun too as we wade through the ANZ news and look at what the RBA is doing and try and figure out where the AI bubble and gold go next.
Can't wait, JT. Thanks for having me.
Terrific. Thanks for coming in, James, and thanks to you for listening. If you like the podcast and you want to hear more, consider sharing or giving the podcast a review, as it helps other listeners find us. And don't forget to follow wherever you get your podcasts. At the Financial Review, we investigate the big stories about markets, business and power. For more, go to afr.com and you can subscribe to the Financial Review, the daily habit of successful people, at afr.com/subscribe. Chanticleer was hosted by me, James Thomson, and James Chessell. It was produced by Mandy Coulin and Alex Gow. Our theme is by Alex Gow. Head of Premium Content is Fiona Buffini.
The Australian Financial Review.